Have you ever felt like you're working incredibly hard to build wealth, laying down brick after brick?
Right, doing everything you're supposed to do.
Exactly. Only to discover that inflation and taxes are just, well, quietly dissolving your foundation right from underneath you.
Yeah, it's a completely frustrating reality for anyone trying to accumulate capital right now.
I mean, you think you're building this impenetrable fortress, but you're actually building on a sinkhole.
You follow the conventional wisdom, you save a portion of your paycheck, but then the macroeconomic environment shifts where the tax codes undergo these massive overhauls.
And suddenly that conventional wisdom is bringing leaks everywhere.
Exactly.
So today we're doing a deep dive into pouring a foundation that actually lasts. We're extracting the exact architectural blueprints from the Secure 2.0 Act and the 2025 One Big Beautiful Bill Act, or OBBA.
Which is such a critical framework to understand.
It really is,
Yeah.
because we want to show you how to truly shield your wealth. If you map these new tax codes out, the whole structure fundamentally changes from simple tax deferral to, like, lifetime tax optimization.
Right. It's a totally different game now.
So we're going to break down the mechanics of 401ks, IRAs, and these newly updated educational savings vehicles, specifically for the 2026 landscape.
Because the rules of capital accumulation really have changed at a fundamental level. I mean, the government has essentially solidified the seven-bracket income tax system.
Yeah.
And they've adjusted standard deductions for inflation. But the real structural adjustments, the ones that act as the rebar in your foundation,
Yeah.
Require an exhaustive understanding of these new contribution limits.
Okay, let's unpack this. We have to start with the most immediate foundational tools that almost everyone listening probably interacts with.
You mean employer-sponsored plans and personal IRAs?
Right, exactly. Because understanding the 2026 inflation adjustments here is basically the prerequisite for literally all the other wealth strategies we're going to explore. So what are the baseline numbers we're actually looking at?
Well, for the 2026 tax year, if you have a 401k, a 403b, or a governmental 457b, the elective deferral limit, so the amount you personally direct from your paycheck, has increased to $24,500.
Okay, 24,500. I look at a number like that and I have to ask, is this limit actual progress?
That's the big question, isn't it?
Right. Or is it just the IRS extending the length of our treadmill because inflation increased the speed? Are they just giving us a slightly bigger bucket to throw sand into?
That is a highly accurate way to view the elective deferral on its own. It really merely paces with inflation.
So we're just treading water to maintain the same purchasing power.
Pretty much.
Yeah.
But it becomes a distinct advantage when we look in Section 415C.
Oh, right. The ceiling.
Exactly. Section 415C is the IRS's absolute ceiling for every single dollar that enters your account from all sources. So that includes your personal deferrals, plus any employer match, plus profit sharing.
Okay.
For 2026, that total Section 415C ceiling has risen to $72,000.
Wait, $72,000?
Yep.
That is a massive gap between the $24,500 you put in yourself and the absolute ceiling.
It is a huge delta.
We are definitely going to talk about how to legally fill that gap later. But what about personal IRAs for 2026?
So the standard limit for both traditional and Roth IRAs is now $7,500.
Okay, pretty straightforward.
But the mechanics get highly specific with catch-up contributions. The standard catch-up for people aged 50 and older is $8,000 for workplace plans.
Right.
However, Secure 2.0 introduced something completely new called the Super Catch-up.
The super catch-up.
Yeah. If you attain the specific ages of 60, 61, 62, or 63 during the calendar year, you're eligible for an enhanced catch-up limit of $11,250 in your workplace plan.
Wait, only those 4 specific ages? Like, what happens when you hit 64?
You drop back down.
Are you serious?
Yeah, you drop back to the standard $8,000 catch-up limit. It is a highly, highly targeted window.
That feels so arbitrary.
Well, the legislative intent here is to basically let people sprint right before they cross the traditional retirement finish line. They want you accumulating as much capital as possible before the required minimum distribution phase kicks in during your 70s.
Okay, I understand the logic of the sprint, but here's my major point of confusion from reading the sources. Starting in 2026, there is a new mandate for high earners.
Ah, yes. The high earner mandate.
If your prior year FICA wages, meaning, Box 3 on your W-2 exceeded $150,000 from that employer, you actually must make all your catch-up contributions on an after-tax Roth basis.
That's right.
You don't get the pre-tax deduction anymore. What is the logic there? I mean, the whole point of traditional retirement accounts during your peak earning years is deferring that massive tax hit.
If we connect this to the bigger picture, it is purely a calculated macroeconomic maneuver by the Treasury.
How so?
Well, the federal government uses a 10-year budget window to score the cost of legislation. By forcing high earners into Roth catch-ups, the government locks in that tax revenue today.
Oh, instead of waiting 20 years for you to start taking distributions.
Exactly. It artificially boosts the tax revenue in the current 10-year window to help balance the cost of the Secure 2.0 Act.
Wow, so it is literally a budgetary trick that forces the taxpayer to pay up front?
It is. But here's the critical mechanism that could trip up a lot of listeners. The IRS provided a 2-year administrative transition period for this rule because, honestly, payroll providers were completely unprepared to implement it.
Right, their systems just couldn't handle it.
And that transition period ends in 2026.
Which means the employer's payroll systems have to be updated to physically route those specific funds into a Roth bucket, or the system just breaks.
Exactly. And if an employer has not updated their payroll system and amended their plan document to allow for Roth contributions by this deadline, high-earning employees will be entirely locked out of making catch-up contributions altogether.
Wait, really? Locked out completely?
Entirely. The software will simply reject the pre-tax contribution, and with no Roth alternative built into the system, the employee loses that tax advantage space entirely.
Oh, wow. So if you are listening to this and you make over $150,000, you need to be sending a very polite but firm email to your HR department right now.
Strongly agreed.
You have to verify that their payroll software is fully secure 2.0 compliant for Roth catch-ups, because you cannot build a foundation if the concrete truck never arrives because of a software glitch.
That is the exact takeaway.
All right, so we've established how to shield up to $72,000 using standard employer plans. But for aggressive savers or high earners, that ceiling is reached pretty quickly. So where does the overflow go to avoid getting crushed by taxes? That brings us to the accounts the sources identify as having the highest contribution density, specifically health savings accounts, or HSAs, and the mega backdoor Roth.
The HSA is, without a doubt, perhaps the most structurally powerful tax advantage tool in the entire U.S. tax code.
It's incredible.
For 2026, the contribution limits are $4,400 for a single individual and $8,750 for family coverage.
Okay.
But there are strict architectural requirements to even open one. You must be covered by a qualifying high-deductible health plan, or HDHV.
And there's a very specific nuance there for families in 2026 regarding the embedded deductible. How does that actually work in practice? Because it sounds complicated.
It is a mechanism where many people inadvertently disqualify themselves. An embedded deductible basically means that even within a family plan, an individual family member has their own separate lower deductible.
Okay, I follow.
For 2026, the absolute minimum deductible for a family plan to qualify as an HDHP is $3,400.
Right.
If your family plan has an embedded deductible for a single individual that is lower than that, say $3,000, the entire plan fails the IRS test.
Wait, let me make sure I'm visualizing this correctly. Let's say I have a family of 4. One person breaks their arm. If my insurance policy starts paying out to cover that broken arm after only $3,000 of out-of-pocket costs, the policy kicks in too early.
Exactly.
And the IRS views that and says this isn't a high-deductible plan anymore and completely strips your eligibility to contribute to an HSA.
That is the exact mechanism. The embedded individual limit cannot undercut the statutory family minimum.
That is a brutal trap.
It really is. Assuming your plan is compliant, however, the HSA offers a triple tax advantage. The money goes in tax deductible, it grows tax deferred through investments, and it comes out tax-free for qualified medical expenses.
But the strategy our sources outline isn't about using the HSA to buy, like, cough syrup today, though.
No, definitely not.
It relies on the no deadline rule because the IRS currently imposes no time limit on when you must reimburse yourself for a medical expense as long as the HSA was established before the expense was incurred.
Right. And that structural loophole is what transforms the HSA from a short-term spending account into a massive generational wealth vehicle.
I always think of the strategy as a tax-free shoebox of receipts. You know, you go to urgent care in 2026 and it costs you $500. Instead of swiping your HSA debit card, you pay cash out of your regular checking account.
Yep.
You save that receipt in a digital shoebox. Meanwhile, you invest that $500 inside your HSA into a broad equity index fund. You let it compound for 30 years. Then in 2056, you hand the IRS your receipt from 2026. You pull out your compounded money completely tax-free, and you can use it to buy a boat or fund your lifestyle without generating a single cent of taxable income.
That is the beauty of it. Treating an HSA merely as a checking account for current medical spending leaves an enormous amount of compounding potential on the table.
But what about people who are afraid of overfunding it? Like, what if you simply don't have enough medical receipts to withdraw all those funds later in life?
That's a common fear, but it's largely unfounded. After age 65, the 20% penalty for non-medical withdrawals is permanently waived.
Oh, because at 65, the IRS essentially reclassifies the account. They remove the strict medical requirement and start treating it identically to a traditional IRA.
Right, you just pay ordinary income tax on the withdrawal if it isn't for a medical expense.
So the flexibility is just unmatched.
Truly unmatched.
Let's move to the other high-density vehicle, the mega backdoor Roth. We mentioned earlier that the Section 415C total limit is $72,000, but the employee deferral is only $24,500.
Right, leaving a massive delta of $47,500.
Yeah. So how do we legally push that much capital into a tax-free space?
You utilize a mechanism within specific 401k plans that allows for after-tax, non-Roth contributions.
Okay.
So you contribute your surplus capital into this specific after-tax bucket. Because it is after-tax, you receive no deduction today.
Makes sense.
The crucial step, however, is the immediate conversion. The plan must allow for an in-service distribution or an in-plan Roth conversion.
Meaning you are moving the money out of that after-tax sub-account and permanently locking it into the Roth side of the house while you're still actively working for the employer.
Yes, and by moving it to the Roth side immediately, before any significant earnings accumulate on the principal, you bypass the tax drag on the future compounding.
Oh, wow.
From that second forward, all the growth and all the eventual withdrawals are completely tax-free. It allows high earners to effectively bypass the standard IRA income limits.
And it largely sidesteps the complexities of the pro rata rule that plagues standard backdoor IRAs, right?
Exactly. Shielding up to $47,500 of capital annually.
Amazing. But, a foundation isn't just a floor for you to stand on. It's the ceiling for the next generation. We need to look at how the One Big Beautiful Bill Act and Secure 2.0 have radically transformed accounts that used to be strictly restricted to textbooks and dorm rooms.
The education savings landscape has genuinely seen a paradigm shift. Traditionally, 529 plans were these rigid vehicles strictly for college tuition.
Right. Very restrictive.
But now, under the OBBBA, the annual withdrawal limit for K-12 tuition and expenses has doubled to $20,000 for 2026.
That's significant.
It is. Coverdell education savings accounts also remain relevant. They're capped at $2,000 a year. But those can be deployed for highly specific K-12 expenses that a 529 might not cover fully, like mandatory school uniforms or specialized tutoring.
Okay, but here's where it gets really interesting. The 529 to Roth rollover. For years, the number one fear I've heard from parents is, what if I aggressively fund a 529 and my kid gets a full-ride scholarship or decides to start a business instead of going to college? Is my money just trapped?
Under the new legislative framework, it is no longer trapped. You can roll unused 529 funds directly into a Roth IRA for the exact same beneficiary.
That is huge.
It is, but the IRS built in specific guardrails to prevent this from becoming, a short-term tax evasion scheme.
Of course they did. What are the rules?
The 529 account must have been open and seasoned for at least 15 years. Furthermore, you can only roll over the standard annual Roth limit each year, which is $7,500 in 2026, and there is a strict lifetime maximum rollover of $35,000 per beneficiary.
Even with those guardrails, dripping $35,000 into a 22-year-old's Roth IRA right as they enter the workforce is monumental. The compounding on that capital over a 40-year time horizon completely changes the risk profile of saving for your kids.
It absolutely does.
Now, our sources also detail a brand new vehicle created by the 2025 OBBBA, the Section 530A accounts, which the legislative text often refers to as Trump accounts. Now, just to be clear to you listening, our goal here is to impartially convey the mechanics as presented in our legislative sources today without endorsing or critiquing the politics behind them. We're just looking at the facts. So purely mechanically, how do these Section 530A accounts function?
Looking strictly at the legislative rules established by the Act, Section 530A accounts are custodial-style traditional IRAs established specifically for children under the age of 18.
Okay, so a kid's IRA.
Basically. And they operate with a few highly specific parameters. First, eligible U.S. citizens born between 2025 and 2028 receive a one-time $1,000 federal seed contribution to open the account.
So the federal government is providing the initial kinetic energy to start the compounding engine.
That is the design. From there, parents, family members, and even employers can contribute up to $5,000 per year in aggregate.
Wow.
But the most notable mechanic is the strict investment mandate during the growth period before the child turns 18.
What's the mandate?
The funds are legally required to be invested in broad-based U.S. equity indices, and the annual expense ratios are capped by law at a maximum of 0.10%.
Oh, interesting. Which means federal law is essentially enforcing low-cost, Boglehead-style investing. You cannot pick individual tech stocks or meme stocks for your toddler's 530A account.
Exactly. The architecture explicitly prohibits speculative trading. Distributions are also generally prohibited until the child turns 18, except for qualified rollovers into other IRAs or ABLE accounts for children with disabilities.
What's fascinating here is the historical shift. I mean, when you strip away the noise and look at the underlying mechanics, we are talking about the institutionalization of early childhood investing.
Right.
We are looking at a legislative framework designed to create the first generation of Americans to have compounding retirement assets established literally from their birth year.
What's fascinating here is how it fundamentally alters the timeline of capital accumulation. It just shifts everything forward.
Which brings us to the most important part of this entire deep dive. Because knowledge without application is just trivia at a dinner party.
Sure.
We need to build a mental blueprint for you listening. Let's give the 2026 strategic order of operations. If I am mapping this out chronologically, how do we sequence the funding of these accounts to maximize total wealth?
The sequence relies on capturing free capital first, then prioritizing tax efficiency based on your current marginal tax brackets. Step 1 is universally the workplace match.
Always step 1.
Always. You contribute the exact percentage to your 401k or 403b required to receive the full employer match. That is the 100% immediate risk-free return on your capital.
And once that match is secured, step 2 is redirecting cash flow to the HSA. Because of the triple tax advantage and the fact that contributions made through payroll also dodge FICA taxes, it's mathematically superior to almost any other vehicle.
Assuming you have the qualifying high-deductible health plan, yes. Step 3 is where the tax strategy requires personalization.
Right, because of the tax brackets.
Exactly. You have to evaluate Roth versus traditional contributions for your IRAs or your remaining workplace limits.
And the sources provide a very clear heuristic for this in 2026. If you're in the lower marginal tax brackets, the 10%, 12%, or 22% ranges, you prioritize Roth accounts.
Yep. You pay the tax now because the historical rate is low.
But if you're a high earner sitting in the 32, 35, or 37% brackets, you prioritize traditional pre-tax accounts. You want to capture that 32% or higher tax arbitrage today, assuming your effective tax rate in retirement will be significantly lower when you finally withdraw it.
That heuristic optimizes your lifetime tax liability perfectly.
Okay, so once I've made that tax bracket decision in step 3, I assume step 4 is going back to finish what we started in step 1. We need to fill up the rest of that $24,500 workplace deferral limit before looking for outside accounts.
That is the correct logical progression. Maximize the primary tax advantage space provided by your employer first.
Which leads us to step 5 for the superchargers. If you have hit the deferral limit, maxed the HSA, and funded your IRAs, step 5 is executing the mega backdoor Roth. You soak up that remaining $37,500 delta with after-tax money that you immediately convert to Roth.
And finally, step 6. Once every single tax advantage mechanism is exhausted, you utilize a standard taxable brokerage account for any remaining surplus capital.
So what does this all mean for you listening? How do you plan to reallocate your next paycheck based on this chronological sequence? Are you hitting that employer match but completely ignoring the massive tax shield of an HSA?
It's a common mistake.
Are you putting money into a taxable brokerage account before you've maxed out your Roth space? Because the order in which you deploy your capital determines the structural integrity of your foundation.
This raises an important question regarding a concept known as asset location. The 6 steps we just outlined tell you which accounts to fund. Asset location dictates what you put inside them.
Because not all investments generate the same type of tax drag, right?
Precisely. A stock that pays qualified dividends is taxed very differently than a corporate bond paying ordinary income interest.
Okay, so how do we place them?
You want to place highly taxed, tax-inefficient assets like corporate bonds real estate investment trusts, or actively managed funds that generate a lot of short-term capital gains inside your tax-sheltered accounts, like a traditional IRA or a 401k.
And the efficient stuff.
Conversely, you place tax-efficient assets like broad market index funds with low turnover or tax-free municipal bonds into your standard taxable brokerage accounts. Placing a tax-free municipal bond inside a tax-free Roth IRA is just mathematically redundant.
It's like putting a bulletproof vest on a tank.
Okay.
You are completely wasting the defensive capabilities of the Roth IRA on an asset that already shields itself. The accounts are the fortress walls, but asset location is how you strategically arrange the defenses inside those walls.
The 2026 landscape really requires that level of granular planning. The OBBA's solidifying of the tax brackets, the expansion of 529 plans, the introduction of mandatory Roth catch-ups, it all signals a macro shift.
Yeah, the federal government is willing to give you immense tax-free growth tomorrow, as long as you understand how to navigate their phase-outs and compliance rules today.
Exactly.
This isn't about hiding money in offshore accounts. It's about playing the ultimate game of chess with the IRS, using the exact legal tools and rule books they have built and provided for us.
It's all right there in the blueprints.
And that brings me to a final thought I want to leave you with. Something for you to mull over as you look at your own financial blueprints tonight. Imagine a child born today. They receive a Section 530A account at birth, seeded by the government and funded by family. In their 20s, any leftover money from their 529 education plan is rolled over to systematically jumpstart their Roth IRA. And from the very first month of their first job, they begin using an HSA as a stealth compounding retirement fund using that no deadline receipt strategy.
It's a completely different paradigm.
If you string all of those specific legislative mechanisms together, a 60-year compounding window is no longer a mathematical outlier. It is the new baseline. The traditional concept of starting to save for retirement in your 40s might become completely obsolete.
Absolutely.
So ask yourself, as these new multi-generational tools come online, how does that change your strategy for the legacy you want to leave behind? Are you just saving for a traditional retirement, or are you architecting a century of compounding? Take a look at your blueprints and make sure the foundation you're pouring today is actually airtight.